There is a specific kind of silence that descends on Wall Street on a Friday evening. Usually, it is the silence of relief. The trading week is over. The terminals go dark. The bankers head to the Hamptons to pop champagne. But this weekend, the silence is different. It is the silence of a bomb squad staring at a wire they just failed to cut. We just witnessed something that was not supposed to happen. According to the script, the algorithm that has run for 40 years, silver was supposed to crash on Friday. They tried to smash it at 65. They tried to smash it at 66, but the market didn't just hold, it accelerated. The closing price on the screen is 67.14 to let that number sink in. 67.14. We didn't just break resistance, we blew the roof off the building. We closed at the absolute highs of the week. For you, the retail investor, this is the moment of celebration. But inside the risk management departments of the major bullion banks, this is a nightmare scenario. Why? Because the markets are closed. They are stuck. They are holding billions of dollars in short positions that are now deeply underwater. And they have to sit there for 48 hours, unable to trade, unable to hedge, unable to stop the bleeding. To understand the magnitude of this, you have to understand the Friday script. For decades, they used the 10 a.m. smash. But it's like clockwork. They would dump paper to ruin your weekend. But this time, the buyers didn't blink. They aggressed. They bought the offer. They cleared the book right up to the final bell. This tells us the suppression algorithm is broken. The banks ran out of bullets before the market ran out of money. When a market closes on its highs on a Friday, it rarely opens quietly on a Monday. The panic is building behind closed doors. And when those doors open, the stampede begins. This is the story of the weekend the banks lost control. The media will try to spin this as volatility. We know it is a default. Y'all, we need to hit 1,000 subscribers to spread this intel before the market opens on Sunday night. Subscribe now. Let's walk into the risk room. If you are just joining us, let's reset the scene. It is Saturday. The markets are closed. The price of silver is frozen on the screens at 67.14. To the outside observer, the financial world is asleep. But inside, the glass towers of Manhattan and London, the lights are burning bright. We need to walk into the risk room. Every major bank has a department whose only job is to make sure the bank doesn't blow up. Right now, those risk managers are looking at a spreadsheet that is bleeding red ink. They are looking at the short exposure of their clients, the hedge funds who bet against silver, and they are realizing that many of those clients are insolvent. Here's how a weekend margin call works. For you and me, if we run out of cash, the app just closes the trade instantly. But for the big whales, institutional money, it works on variation margin. At the end of every day, the exchange calculates who won and who lost. The losers have to wire cash to cover the difference. Usually, this is a routine. A few million here and there, but Friday was not routine. The move to 67.14 was violent. It caught the shorts completely off guard. They were leveraged to the hilt, expecting a dip. When the bell rang on Friday, they were staring at losses that exceeded their cash on hand. So, this is the phone call happening right now. The prime broker calls the hedge fund manager. You are down $500 million. You have exceeded your credit limit. We need you to wire $300 million by 8 a.m. Monday morning. The fund manager says, I can't. The banks are closed. I have to sell other assets first. The prime broker says, if the wire is not there by 8:01 a.m., we will liquidate you. This is the forced liquidation. It doesn't matter if the manager thinks silver will go down next week. He has no cash. The bank takes control. And the bank's computer has only one instruction: close the position. Since they are short, closing the position means buying. Buying at any price. Buying until the risk is zero. This is what creates a gap up on Monday. It isn't people rushing to buy because they love silver. It is banks rushing to buy because they are terrified of their own clients defaulting. We are looking at a potential cascade of defaults on Monday morning. And the first domino just tipped over. Now, let's leave the hedge funds and look at the physical market. The online bullion dealers, the local coin shops, the wholesalers, they are in a state of shock. Imagine you are a coin dealer. On Friday morning, when silver was lower, you sold 1,000 ounces to customers for $64. You took their cash. You promised to ship the coins. You expected to call your wholesaler on Monday and buy those coins for $63 to make a small profit. But now the price is $67.14. And worse, the premiums are rising. To replace the coins you just sold, you might have to pay your wholesaler $70. You just lost $6,000 in a single day. You sold gold to buy paper, and the paper lost value. This is called a replacement cost risk. In a violent bull market, selling inventory is dangerous. If you sell your stock and the price jumps before you can restock, you bleed capital. You literally go out of business by selling your product. So, What do dealers do on a weekend like this? They freeze. Go to the major bullion websites right now. Look closely. You will see one of three things. 1. Sold out banners. They are hiding their inventory. They have the metal, but they won't sell it to you at this price. 2. Maintenance mode. They shut down the entire site to stop the bleeding until Monday. 3. Massive premiums. They jack up the price to $80 just to discourage you from buying. They are trying to survive. They are waiting for Monday to see if the price is real. This creates a physical vacuum. The demand from the public is exploding because of the price rise. But the supply has vanished because the sellers are terrified to sell. Buyers with cash. Sellers in hiding. The only way to bring the sellers back is to bid the price much higher. There is a bigger game being played at the very top of the wealth pyramid, the unallocated accounts. We touched on this before, but this weekend, it is the only thing that matters. Here is the secret. Banks hold billions of ounces of silver on behalf of wealthy clients. But most of this is unallocated. That means you don't own a specific bar, you own a claim on the bank's pool of metal. The bank takes your money, tells you own silver, but then they lease that silver out to industry or use it to hedge. They run a fractional reserve. They might have 1 real ounce for every 10 ounces they sold to clients. But when the price hits $67 and when rumors of shortages start flying, the wealthy clients get nervous. They ask the dangerous question, does the bank actually have my silver? This weekend, we are hearing reports of a quiet bank run on the vaults. Major family offices are sending instructions to convert their unallocated holdings to allocated. Allocated means put my name on the bar, move it to a segregated shelf. Send me the serial numbers. This forces the bank to show its hand. If they have the silver, fine, they move it. But if they don't, if they leased it to Samsung or sold it to China, they are trapped. They cannot tell a billionaire client, sorry, we don't have it. That triggers a lawsuit and an instant collapse of confidence. So what do? They go into the market and buy it immediately. They pay 68 else, they pay 70. They pay whatever it takes to get the bars into the vault before the audit on Monday morning. This internal squeeze is invisible to the retail trader. You won't see it on the news, but it is the driving force behind the resilience of the price. The banks are bidding against each other to secure the metal they owe to their own clients. They are trapped in a web of their own rehypothecation, and the billionaires are calling the bluff. To understand why the West is running out of silver, you have to look at the arbitrage spread. Right now, the COMEX in New York closed at $67.14, but the Shanghai Gold Exchange is trading significantly higher due to the solar demand and the battery panic. Silver in China is effectively trading closer to 70 L. This is a $5 gap. In the world of commodities, a $5 gap is a black hole. It has infinite gravity. If you are a global refiner, where do you send your silver? Do you send it to New York to sell for $67? Or do you send it to Shanghai to sell for 70 TL? You send it to Shanghai. Every single bar that isn't nailed down is being put on a pallet and flown to China. This is the Shanghai Magnet. It is sucking the liquidity out of the Western financial system. And because the markets are closed this weekend, the spread might widen even further before New York opens. While New York sleeps, the metal leaves. There is another drain on the supply that you will never see on a chart: direct procurement. In a normal market, companies like Samsung or Tesla might buy silver futures to hedge. But in a shortage, futures are useless. You can't build a car with a paper contract. You need the metal in your factory. So, what are these giants doing this weekend? They are cutting deals at the mine gate. They are calling the mining companies directly. We will buy your entire production for the next 2 years. We will pay you 70 and we will pick it up ourselves. Again, this is catastrophic for the COMEX. The COMEX relies on the excess silver from miners flowing into its vaults to back the contracts. But if Tesla buys the silver before it even leaves the ground, that silver never reaches the COMEX. It disappears from the public ledger. This leads us to a controversial truth. The spot price is broken. For 40 years, we accepted that the price on the screen was the real price. But if you go to a wholesaler today and say, I want to buy silver at the spot price of $67.14, they will laugh at you. They will say, good luck, our price is 78, not in the check to spot. Price has become a reference rate for paper gambling, not a purchase price for physical goods. The private market knows there is no silver at 67, and this weekend they are busy securing the last remaining stockpiles before the rest of the world wakes up. We have reached the final chapter of this weekend market alert. We have dissected the Friday close at $60.14. We have exposed the panic inside the bank risk rooms. We have tracked the physical metal fleeing to Shanghai. Now we are left with the silence of Saturday, but this silence is deceptive. It is the deep breath before the plunge. In less than 36 hours, the Asian markets will open for the new week. And the banks, the hedge funds, and the industrial buyers will all rush through the same door at the same time. So here is your Monday battle plan. For silver investors, Sunday evening is the Super Bowl. At 6 p.m. Eastern, the Globex futures market opens. We are watching for the gap and go. If the panic is real, if the margin calls are enforced, we will see the price open significantly higher, maybe 68.50 cents. This creates a gap on the chart. Empty space where no trading occurred. Here's the danger. You wake up, see green, and feel FOMO. You want to buy immediately. Stop. Markets rarely go up in a straight line. There's a technical phenomenon called filling the gap. Often the price will spike, then drift back down to the breakout level, 67.14, to test it. It checks the launch pad before leaving Earth. If you buy the spike, you suffer the drawdown. Wait for the retest. If it holds 67, that is your entry. Patience pays. Next, watch the $70 level. This is the psychological wall. The banks will defend this with everything they have. Expect turbulence here. We might hit 69, 90 and bounce off, but if we break $70, the chart becomes vertical. The bear thesis is destroyed. The skeptics have to capitulate and buy. But I must warn you of the downside scenario. What if this is a trap? The banks might use the thin liquidity on Sunday night to engineer a rug pull. They could dump massive paper contracts to smash the price back to $65, trying to trigger your stop losses and break your spirit. If you see a drop on Monday, do not panic. Remember the fundamentals. Remember the empty vaults. Remember the Shanghai spread. A paper smash doesn't create more silver. It just gives you a better price to accumulate. I want you to take a breath. Turn off the charts for a second. I know this weekend feels intense. I know the volatility makes your stomach churn. That is by design. The system is built to make you feel stupid for holding and terrified for buying. They want you emotional so they can steal your position. But look at what we just proved. The script is broken. The Friday smash failed. The physical market is screaming the truth even while the paper market tries to whisper lies. You are not wrong. You are just early. And in a world of infinite debt and shrinking resources, early is the only place you want to be. The banks are having a nightmare weekend because they are short. You should be having a great weekend because you are holding the solution. You did the work. You ignored the noise. You stacked the metal. Now sit back and let the market panic. You are already in the lifeboat. So watch the Sunday gap. Watch the retest of 67. Ignore the media FUD. The nightmare scenario for the banks is the dream scenario for us. $67.14 is just a mile marker. The destination is much further down the road. This is the story of the weekend the banks lost control. The next 48 hours will define the rest of the year. We will be tracking every move, every margin call, and every physical delivery. Subscribe right now. Stay sharp, stay stacked, and I will see you on the other side of the open. Class dismissed.